I'd like to show you the research that completely turned strategy upside down for a game developer. A quick caveat that because the project and these findings are confidential, this video is only for illustrative purposes of how we came to these findings. The numbers and some of the details have been altered to preserve confidentiality. So this project was for a video game developer, and their original objective was to understand demand for a new game they are developing. The game is an action survival game, specifically in virtual reality, and they're looking to price it at the low end of the spectrum. Their initial target customer was teenagers, specifically between 13 and 16 years of age. One objective was to confirm that this age group is truly the primary target. We conducted an online survey with 800 gamers, and in this survey we were given a discrete choice task in which they had to pick among different games. The games varied by genre, the price for the game, and the platform on which the game is available. What you're seeing right now here is already the output of the analysis. If you're not familiar with the output of discrete choice models or other choice-based conjoint methods, let me take a second or two to walk you through what you're looking at. Each row on this spreadsheet is a respondent. The columns are the product attributes and their levels that we tested in the discrete choice task. So for example, one game attribute we tested was game genre, because the product people chose among varied by game genre. So here you see this block, here's game genre, and the different game genres we showed were first-person shooting game, and here as a reference we said like Call of Duty. Then there was action survival game, simulation game, role-playing game, etc. Different game genres. Next to it you see the columns referring to another attribute by which the products varied, price of the game. The levels we tested were $49, $59, $69, and there was $59 plus downloadable content, $69 with downloadable content and loot box in the game. Then we varied the games that were available by platform. Some were only available for console, some were available in VR, some available for mobile, and then streaming. These lots and lots of numbers that you see are the result of the discrete choice analysis. They are the outputs based on the thousands of choices respondents made. Without getting too technical, think of them as the coefficients of a regression model. We call them utility scores, and they reflect the value each respondent placed on each of these attribute levels. However, they didn't place these values consciously. This is what the statistical model derived after observing their choices. So, for example, let's look at the scores for the first respondent. For the genres, this person's lowest score is for sports games, negative 0.65. Their scores are in the negative for role-playing and multiplayer role-playing game. This means that this person tended to not select those genres when shown, and so this person produced low scores for those genres. His highest score is for simulation games. Just from this information we know that this person, when given the chance, would likely pick a simulation game out of this set. Now, because a product's total value is the sum of the values of the components, we can now calculate how much value a product would be for a respondent if it had certain attributes. For example, our client is coming out with an action survival game for $49 that is available in VR. The total score for that game for this respondent would be a score of 0.53, which is the sum of the scores of the components for a game that is made up of those attributes. What you see here in this column is exactly what I had just described. These are the utility scores for each survey respondent for my client's product, which is an action survival game for $49 available in VR. As you can see, some of the scores are lower than others. What that means is that there are respondents who wouldn't care that much for an action survival game for $49 in VR, and then there are respondents with relatively high scores, and these are likely respondents who would likely prefer such a game. In order to make sense of all of this, I grouped these scores into 3 groups. This is somewhat arbitrary, but those who scored lower than 0.5 were in Group 1, and those who scored higher than 2 were in Group 3. Group 3 is my target. These are respondents who value an action survival game for $49 in VR very highly. Now that I have these 3 groups by preference for the product, the next step is to analyze demographic indicators of my respondents against these 3 groups. Here, for example, is a chart on education, highest degree earned, high school, college, advanced college. And you can see how prevalent a group is in that demographic indicator. Everything is indexed to 100. An index of 100 means that that group is exactly as likely as everyone else. In other words, they're not any different than the total sample. Here's an example. The orange bar is our Group 3. Our target group, when it comes to high school education, the orange group has an index of 105, which means that our target is a little more likely to have only high school education than the total sample. 105 is not much different. Certainly, we can say that's a unique characteristic, and it's not statistically significant. A typical rule of thumb is that we want to be seeing an index above 120 or below 80. When we see that, we can call it out. When it comes to education, you can see that Group 3 is not significantly different from the other groups. We can see some directional information, but it's not strong enough. How about urban or rural? Do we see any differences for our target group? The answer is no, we do not. Group 3 is just as likely to be urban as rural. Next, we see age. Now here, it becomes very clear that the 12 or younger group over-indexes on Group 3. Group 3 is much more likely to be 12 or younger than any other age group. Our client's original primary target customer was teenagers from 13 to 16. However, what the data says is that there's an age group, 12 or younger, that is much more likely to be in the target group than other groups. Using this insight, our client changed its go-to-market strategy. They reshaped targeting, reworked messaging to target a group they originally ignored. They shifted marketing dollars to focus on this age group and their parents to become much more effective. I hope you enjoyed this tutorial, and I'd like you to imagine how your organization could become more efficient at targeting by using these methods.